Welcome, dear traders. On a Thursday, the Fed's hawkish stance and expectations of a sharp rate increases are weighing on equity markets. Asian stock markets are trading mixed after Wall Street closed in the red. So, risk assets are likely to drop lower and their bearish sentiment will only intensify. Yesterday, Wall Street ended the month with its fourth straight daily decline, cementing the weakest August performance in 7 years. Risk assets are still trading significantly above the levels looked before the July FOMC meeting. Pessimism is also mounting because September is historically considered the worst month for the stock market. Moreover, it's the only month of the year when shares fall more than they rise. Traders should also keep in mind that the market sentiment has turned sour as major central banks have switched to sharp rate hikes. Although there are some signs that inflation has perked, and the Fed has pledged to aggressively raise the interest rate in the long term. Cleveland Federal Reserve Bank President Loretta Mester said on a Wednesday that the central bank would need to boost interest rates somewhat above 4% by early next year and hold them there in order to cap inflation. She also pointed out the risks of a recession in the United States over the next year or two. It's far too soon to say that inflation has perked, let alone on a downward path to 2%, Mester said. As long as the Fed sticks to monetary tightening, the US dollar will maintain its bull run versus its main rivals. Today, the greenback has finally snapped its losing streak, coming out on the top. It rose to a 20-year high. In the Asian session, the US dollar index was trading in the upward channel of 108.77 and 109.13. However, analysts believe that speculators have not fully priced in the Fed's hawkish policy. This is why the US dollar may climb even higher, and this assumption seems accurate given that today the US currency has already touched 108.90 thanks to a strong bullish bias. As usual, the US dollar grew significantly against the yen. The dollar-yen pair reached 139.69, a 24-year high. The main bearish factor for the yen is the widening gap between the key rates of the Fed and the Bank of Japan. It means that the Fed's monetary policy decisions will mainly impact the further trajectory of the pair. The Bank of Japan is highly unlikely to make any changes in monetary policy. On top of that, in his speech, Bank of Japan Governor Haruhiko Kuroda outlined the need to stick to an eye-to-lose stance. However, one of the senior officials of the Ministry of Finance noted on Thursday that Japan's government is watching currency moves with a high sense of urgency. Yet the Bank of Japan's verbal interventions did not particularly help the yen regain ground. Besides, the US government bond yields advanced following an increase in the greenback. As seen on the chart, the pair is gradually heading for 140. If it breaks through this level, the next target level could be 139.19. In the Asian session, the pair was trading in the range of 138.93 and 139.68. FX strategies are now expecting the pair to slide to 140, and such a fall in the exchange rate could force the regulator to intervene the support national currency. The risk-sensitive Australian dollar is also losing momentum following a rise in the US currency. It dropped below the support level of August, approaching July lows. The manufacturing PMI index for August slipped to 49 89.3, which was bearish for the Aussie. News from China is also grim. The country has imposed new lockdowns due to a surge in the new cases. Several factories have completely shut down their operation due to the restrictions. Such measures will undoubtedly weaken China's economy, and therefore the near-term outlook for the Australian dollar remains bearish. The AUD-USD pair declined early Thursday to 0.6831, and it's likely to move in a downward corridor of 0.6794 and 0.6848. As September has come, traders are looking forward to the upcoming FOMC meeting. The likelihood of a 75 basis point rate hike totals 75% now. Apart from that, speculators are also expecting fresh macro stats. For example, all EU countries will unveil their manufacturing PMI indexes today, and Germany will reveal retail sales data, and France will disclose its GDP figures. And that's all for now. Subscribe to our channel and keep close tabs on the market developments. See you soon.